Hey, what is up, folks? Zero Fats here, coming at you on behalf of AdventuresOnTheRiver.com. I want to talk to you guys a little bit about taxes today. We're into the tax season, and I want to talk to you about taxes. To do that, I want to use a story method. Some people learn well from stories. Different strokes for different folks. I learn pretty good from stories myself. Well, I'm going to use a story method on you. And let's see how it goes. Alright, see if you can glean some information from it. So this is like taxes as it pertains to someone who's independent, making money on their own. They haven't paid any taxes on that money. Now they have to worry about it at the end of the year. So let's take our guy. His name's Ralph. Let's say his name's Ralph. Well, Ralph, he's working a minimum wage job. Okay, so Ralph is making a lot of money, and he doesn't see a lot of ups in his life. He doesn't see a way for him to get to a better paying job. What he decides he's going to do is he's going to try to do something online. And what happens is Ralph likes to go to garage sales. So Ralph goes to this garage sale one time, and it happens to be the last day of the sale. And Ralph sees a pile of books in the corner. Just a big pile of them in the corner. And Ralph says, what's going on with those books over there? You know, and the guy's like, man, I couldn't sell those things all weekend. No one cares about books anymore. And Ralph says, well, what do you want for them? He's like, you know what? It's the last day of my garage sale. Just take them. Just take them. I'll tell you what, $5, they're all yours. So Ralph gives the guy $5. He loads up about 600 books. About 600 books in that pile. He loads up about 600 books in his pickup truck. All right, his pickup truck has a cab on it, so Ralph's lucky. He loads them all up, takes them home. Now this is about October or so. So it's the end of garage sale season. Only 3 months left in the year. Ralph takes them home, and he's kind of excited. He's like, man, I'm going to sell these books online, you know. So of course the first place Ralph goes is Amazon. All right, that's the biggest place to sell online, you know. And Ralph starts looking through there, figures out it's not hard to get an Amazon account, gets it all set up, and then he starts posting his books for sale online. Well, Ralph's getting excited because now he sees all these books that he's only paid pennies for because he got them all for $5. Some of them are worth a lot of money. Some of them aren't worth any money, you know, but some of them are worth a lot of money. So. And here's how it breaks down for Ralph, right? About 200 of those books that he found are worth good money, right? And about 400 of them aren't worth anything. So about 3/4 of them aren't worth anything. About 1/4 of them are worth something, you know? But that 1/4 of them that are worth something are worth a lot, right? Ralph's probably got about $4,000 worth of books if he sells them for what he put them up at. Great, great. So in the next 3 months, between October and December, you know, Ralph's just getting into this thing. So he doesn't know a lot about what's going on. Ralph does about $375 worth of business. So he sells about $375 worth of books in 3 months. That's not a lot of money. But Ralph's still like, you know, I didn't pay taxes on that $375. So Ralph does some Google research, he asks a couple friends, and Ralph figures out, I don't have to pay taxes on the $375. Government doesn't want taxes on my $375 because they considered it a hobby, because I didn't make $400. So for that year, you know, he only had 3 months there. He was just getting started. He made $375. He didn't have to worry about taxes. It was only $375. The government, he can consider it a hobby. He doesn't have to count it on his taxes. Ralph's thrilled, but he's got a taste of blood now. Now he's got a taste of blood. He's actually made some independent dollars, and now he's feeling empowered. Like, hey, how far could I take this? I mean, yeah, I know I only made $350 or $375, but you know, what could I do if I knew what I was doing? What could I do if I knew what I was doing? What could I do if I pushed this to the max? You know, what could I do on my own? Would I still have to work my crappy dishwashing job I got or whatever? This is what Ralph's thinking, you know. So now his goal for the next year is to completely go 100% independent and to quit his crappy dishwashing job. So here's how he does it. The search is on for books, but not just for books. The search is also on for knowledge, because Ralph wants to know what kind of books make money, what kind of books sell for a lot of money, you know, what works, what doesn't work. How can I make my sales more consistent? How can I do this? How can I do that? Well, guess what? Ralph finds my site, adventuresontheriver.com. Yes, that's a shameless plug, because I put a lot of work into that site. So go check it out if you need some more help selling on Amazon, or you need some help trying to make money on Amazon. But back to our story. Ralph gets edumacated. He gets educated. He gets some more knowledge. And he does a lot better the next year, okay? He does a lot better the next year. Now, luckily, my site has a lot of information on taxes, so Ralph's prepared this next year for his taxes. But here's some of the things that Ralph had to consider, because Ralph made about $3,500 the next year in book sales, which isn't that great, but you know, still it's pretty good. You know, it's pretty good for someone who's never done it before. Let's say he made $3,500. It's not that great. It's not a full-time income by any means, but Ralph had to file taxes on that $3,500. The government's going to want a piece of that. That's not a hobby as far as they're concerned, because it's over $400. So, does the government want taxes on Ralph's $3,500? Now, that's his gross income. That's gross income for his book selling business. Okay, it's gross income because nothing's been taken out of it. No taxes for the state, no taxes for the federal. The only people who've taken money out of that is Amazon. Okay, so what does the government want taxes on? They don't want it on the $3,500. They want it on his adjusted gross income. Now, what is that? That's Ralph's gross income that he made. That's all the money he made, the $3,500, minus his expense, minus his deductions. Okay, well, on that $3,500, you'll see on your Amazon account, and Ralph saw on his Amazon account, how much the Amazon took out of the $3,500. All right, they'll tell him. They'll tell him, hey, we took this much out in fees. You can find it. It's right there. You can pull it up. Ralph found it, so he deducts that in fees right off the bat, you know, from his $3,500. Okay. Let's make it easy. Let's say it's $1,000. $1,000 in Amazon fees. That takes him down to $2,500. Now let's say something else. Let's say Ralph had a dedicated portion of his house, his computer, his little corner of his living room, that is just dedicated to him working on his book business. That's 100% of using that thing just for his book business. Okay, now he can declare that as an office. So what Ralph gets to do, let's say his house is 1,000 square feet. All right, let's say his little office he's got set up for his book business takes up 10% of it. It's 100 square feet. Okay, 10% of his office makes up his house. So what does that mean? And what that means is Ralph can deduct 10% of his heat, 10% of his electric, and 10% of his rent, okay, from his gross income. So from the $2,500, you're going to take 10% of how much he paid for rent that year. You're going to take 10% of how much he paid for electric that year. And you're going to get to take 10% of how much he made from paying, or 10% from how much he made of his heat bill. So whatever, let's say he paid $1,000 in heat for the year. Well, Ralph gets to deduct $100 of that, because that's 10% of that. He gets to deduct that from his gross income. So that $2,500 that he made is now going to come down even lower. Okay, so let's say we deduct all that stuff, and now he's knocked down to $1,500 of what he made. Okay, because he was able to deduct having a home office. It takes up a percentage of his house, and he's able to deduct a percentage of his utilities and rent because of that. Okay, so he's able to deduct more from his taxes, from his gross income. It's an adjusted gross income. Now let's say this. Now let's say, remember when Ralph had about 200 of those books that were worth money and about 400 of them that weren't worth money? Okay, Those 400 books that weren't worth money, what did Ralph do with them? Okay, well, Ralph didn't know anything about setting up a network of other stuff like that. I talk about that on my website, things you can do with those 400 books that aren't worth money. But we're not going to go into that here. We're going to talk about Ralph. And what Ralph did was he donated them all to the Goodwill. 400 books, boom, donate to the Goodwill. He got a receipt. Alright, now what he does is he's able to deduct that on his taxes. It's a charitable donation. So that comes off of his gross income, okay? Let's say that equals out to about $400 worth of books. Now, Ralph kind of wrote a log of all those books. He wrote a log of all those books so he knew what they all were, okay? Doesn't have to be too detailed. Doesn't have to be too detailed. Just the general log so he knows what he donated. Okay, I donated 400 books, you know, 35 of them were nonfiction, 150 of them were children's books, blah, blah, blah. You know, he kind of donated them. Now, Goodwill had a cool little nifty guide for him to tell what the market value is on a softcover book and a hardcover book. So Ralph didn't have any problems going to their guide and tallying up what his books were worth when it came to, like, how much money he donated with those books. So let's say it was 500 bucks worth of books. I might have said 400. Whatever, it doesn't matter. Let's say it was 500 bucks. Now he's down to $1,000, okay, after his charitable donation. Okay, what else? Okay, Ralph was keeping something throughout the year called a compensatory log. I think I'm getting that name right. It's a logbook that you keep, and what it is, you know, when you're dealing in this resale business like Ralph's in, okay, you don't always have receipts. Thrift stores don't always give you receipts. Garage sales don't always give you receipts. You don't always have receipts with the people you're dealing with. Craigslist people, you don't always have receipts. It depends on what you're buying and where you're getting it. Well, Ralph didn't have receipts for a lot of things. But because he was going to adventuresontheriver.com and he was getting educated, he knew he needed to keep a logbook. And what he did, and here's how the logbook works. You need a binded logbook, okay? Not something you can, like a ring, like a wire ring. You don't want that. You want it to be like a solid bound logbook, okay? You want to write in it in order. You don't want any missed pages, okay? Here's what I want you to write. You know, when you get started, you're going to go somewhere to look for books, okay? Or you're going to look for your products. Well, what Ralph did was every time he went somewhere to look for a book or to look for product, okay, he wrote down a couple things. First, he wrote down his mileage. He wrote down the date. He wrote down his car's starting mileage. He wrote down he wrote down his, or let's take it like this. He wrote down the date. He wrote down his starting mileage, right? And then under that, he'd write whatever purchases he made for his business purchases, whether it be books, whether it be whatever, he wrote them down, okay? Now, when he got done with the day, he wrote down his end mileage, okay, up here on that log entry. He left it open there. You know, he was at, let's say he was at, let's be nice to Ralph, let's say he only had 55,000 miles on his vehicle. Let's say when he got done for the day, he was at 55,050 miles. He put 50 miles on his vehicle that day. He closes the log entry there with the 50 miles, okay, and he writes down his purchases for the day and where he got them and how much he spent. That's important. How much he spent, okay? Not how much those products are worth, but how much Ralph spent on them, okay? He's keeping all this in his compensatory log all year long. He's filling out the pages, his mileage and his supply expense, or not supply expense, his inventory. This is his inventory, right? What he's doing is he's keeping track of all the inventory that he's buying for the year, all the books that he's finding, and he's also keeping track of how much mileage he's putting on his car. But not just how much mileage he's putting on his car. He's keeping track of how much mileage he's putting on his car that's dedicated to looking for inventory for his business or supplies. Ralph needed to get a scale so he could weigh his books to send them out. So Ralph goes to Walmart, he buys a scale for $10, $15. He buys a food scale, nice little digital food scale. It's cheaper. He gets it, $10 or $15. He writes it in his compensatory log. Now he saves that receipt because Walmart gives him a receipt, and he puts this in his little receipt folder. Okay, puts this in his little receipt folder. All right, but he writes it in his compensatory log as well. Okay, he dates time he went to Walmart, what he bought. Not the time. You don't have to get that crazy. He writes the date. He writes supply scale, digital scale at Walmart. He writes the price, how much he paid for it. Okay, and he writes his gas mileage, how much he used 5 miles of gas to get there. 5 miles. He started at 15,000 or 55,050 miles. 5 miles to Walmart, 55,055 is what he ended at after he bought the scale. Okay, so those 5 miles are calculated in his compensatory log. He's got it all right there. You see, folks, Ralph kept track of all the mileage he spent on his book business in the compensatory log. He saved the receipts from the gas he bought also. Alright, that's another thing he did. He saved the receipts from the gas he bought. He didn't know quite if he was going to need them or not, but he saved them. Because, folks, Ralph saved all receipts that he had that was related to his book business. He saved them. He thought he might need them with his taxes. Okay? Ralph was smart, you know. He saved all his receipts that he had that was related to his book business. Alright? But he wrote everything down in this compensatory log. Folks, this compensatory log saved Ralph. I mean, it made his life easy at tax time. Okay? So, back to Ralph's taxes. He's down to $1,500. Well, here's what Ralph figures out. The IRS says, well, look, if you got a vehicle that you use part of the time towards your business and part of the time for your personal stuff or your other stuff or whatever, we want to know how much of it is actually used for your business. Well, Ralph kept track of it. He kept track of it in his compensatory log. Now, Ralph knows he used about, let's say he used about 1,000 miles for business. Okay? Now, I think the IRS says we're going to give you 54 cents a mile. Okay? So 1,000. Let's just make it easy. Let's say that's $500. That's $500. $500 more dollars that Ralph can deduct from his gross income because of mileage on his vehicle that he used going all over the place for books. So $500 more dollars off of his gross. Now he's down to 1,000. What does that mean? Okay. Well, let's take it down a little bit more, and then I'll tell you what it means. Okay. Ralph also had expense, okay? He had inventory expense, okay? His inventory was worth so much money, okay? Let's say Ralph spent, now Ralph got garage sale books, Craigslist books, and thrift store books, so he didn't have a lot of money on the spend. Let's say he spent $200 on all his books altogether, $200 bucks, because he's smart. You don't want to spend a lot on your inventory. The less you spend, the more you make. Okay, so $200 on inventory expense, and let's say all year long, let's say he spent another $100 on supplies. So that's $300. What are supplies? Supply expense would be like his bubble wrap envelopes. Supply expense would be like his labels for his bubble wrap envelopes. Supply expense would be like ink cartridges for his printer. You know, because he's printing off the ink, the labels for the things. He has to buy a couple of printer cartridges throughout the year. You know, supply. What else would be expense? Oh, well, guess what? You know, Ralph got a membership to my website. That was $10 that he spent. Okay, well, guess what? That's a deduction. So that's $10 that's coming off of his gross income also. Okay, so let's erase all that and wipe the board clean. Ralph was at $1,000 now of gross income after it's his adjusted gross income. Okay, we're going to let him take another $500 off for all the different supply expense and, you know, inventory and everything. Let's just say we're taking another $500 off for that stuff. Okay, now he's at $500. Okay, that $500 is what the IRS wants taxes on. They want taxes on the $500. They don't want taxes on the $3,500 that Ralph made. They want taxes on the $500 that Ralph made after all his expenses or deductions are taken off. Okay? You see what I'm saying? Now, when you do your taxes for the IRS, when Ralph did his taxes for the IRS, he got a program called TurboTax Home and Business. It's a great program. It makes your life a lot easier. Ralph wasn't too smart about taxes. Before this, all he did was like W-2s for his work. So he needed some help. And TurboTax kind of gave him some help because it asks you a lot of simple questions and it fills out some fairly complicated documents with your answers. So TurboTax Home Business, great solution for Ralph. It worked. And he used it. And he paid his taxes on his 500 bucks. The state wanted some taxes too. They wanted some taxes too on that 500 bucks. So he ended up paying a little bit of taxes to the state, a little bit of taxes to the federal. Okay. So long story short, Ralph made about $3,500 on his book business that year. He only paid taxes on 500 of it. How did he do it? He adjusted his gross. Okay. Now, did Ralph cheat the government? Absolutely not. He did not cheat the government. This is what you're supposed to do when you're in business. All businesses do this. You adjust your gross for expense. Alright? It's your adjusted gross income. You adjust it for expense. Now, what are you responsible for? This is what you had to remember what Ralph did. You have to keep track of what's going on throughout the year. The stuff you're buying for your business. You have to keep track of it. Ralph kept track of all the gas he used that was towards his business, all the mileage, I should say. He kept track of that in his book. That compensatory log is important, okay? Because what it is, you guys, is it's proof. It's proof for the government in case you get audited. Well, here, look, I kept a logbook all year. I wrote dates, I wrote not times. I wrote dates, I wrote how much gas I used, like how much mileage I used on my vehicle. I wrote where I went, what I bought, how much it cost. Boom, boom, boom. It's all right here in this logbook. No pages have been ripped out. It's bound, and I didn't skip any pages. No pages are skipped. Every page is filled out, front and back. There's no skips. It's all right there, okay? Now you're set up for an audit. Okay, now you're set up. You got good records for your audit. And Ralph had good records for his audit. He also had in his filing cabinet every receipt that he had that was related to his business. Alright? Whether it be like a supply that he bought at Walmart, like he ran out of bubble wrap envelopes one day and he went to go to Walmart and get some bubble wrap envelopes. Had to keep a supply of that. His tape. He didn't order his tape in bulk. He was just getting it like at the department store. So he wrote down his expense for that, like $3.95 for the tape. He put that receipt in there, wrote it in his compensatory log. The compensatory log will save you, okay, when it comes to your business, okay? It's a great tool. The IRS considers it proof, like a receipt. It's very important. So that's the story of Ralph, guys. Ralph paid taxes on $500. Now, what happened to Ralph? Well, I'm going to be kind and say the next year Ralph was able to quit his job. He made about $30,000 in online sales, about $30,000. But because he kept a good record when he made the $3,500 the year before, it wasn't too bad for him to do the $30,000 and pay taxes on it. He kept his records the same as year before. The only difference was he made more. He made a lot more. How did he do it? Ralph went to bulk sales. He stopped looking for books at thrift stores and started looking for people trying to unload tons of books. Alright? So that's Ralph. We're going to leave Ralph alone for a little while. So guys, the story is, the moral of the story is, I should say, don't be afraid of taxes, you know. Concentrate on what your adjusted gross income is, okay? You need to try to keep good records throughout the year. You need to try to keep that compensatory log. Go to the store, buy a solid bound book, okay? That's one of those hardbound books that's, you know, solid bound. You know, you turn it like a regular book and you write in it. Hopefully it's lined so you can write, you know, you got room for your log entries. That book's awesome. It's going to save you, okay? You need to keep track of how much mileage you're using in your car that's just dedicated to finding your inventory. You need to keep track of any supplies that you're buying related to your book. When you bought it, where you bought it from, how much it cost, okay? Inventory. When you bought it, where'd you buy it from, how much it cost, right? And then, in addition to the compensatory log, you want to keep all the receipts you have, right? Look, 12/25, blah blah blah. 12/25, 2014. Bought. It hasn't even happened yet. Bought membership to adventuresontheriver.com. $10, right? He wrote it in his compensatory log. Fine, great. Then he printed off the receipt, put that in his filing cabinet. He's got it. He's good to go. It's right there. At tax time, you can add up all his expenses and all the different little categories that they go in. TurboTax, home and business makes that easy for you. Ask you very simple questions, and it fills out very complicated documents. Not too complicated, but you know, when you're not used to filling them out, they can be a little daunting. You know, the Schedule C's, you know, and if some of the other documents, I'm not going to get into them, but put it this way, you guys, put it this way. You know, a few years ago when I was just working at somewhere, I think my tax documents were 17 pages long. This year, my tax documents were 73 pages long. Okay, 73, from 17 to 73. But was it hard for me? No, it wasn't hard for me because I use TurboTax Home and Business, number one, which kind of simplifies things, and I think it's a great program personally. Does it cost money? Yeah, it costs money. I think it's about $100 or so. But that is another tax deduction. The $100 you spend on your tax software is tax deductible. Or if you're like Zero Fats, I don't want to mess around with TurboTax Home and Business. I'm taking my stuff. I'm having someone else do my taxes. Fine. You take your stuff somewhere else. You have them do your taxes. They charge you $300. $300 to do your taxes. That $300 is tax deductible. Okay, you can deduct that. So, anyways, why is it tax deductible? Because it's related to your business. It's related to your business. You're having the taxes done on your business. Let's say you're a sole proprietor and your business is linked to your social security number. That's fine. That's fine. Because now your business is linked to you personally. You're having your taxes done by somebody. Well, that includes your business, okay? So that means that having your taxes done for your business is related to your business. It's a business expense, okay? And it's a tax deduction. So the moral of the story is, I'm kind of rambling on, but the moral of the story is, be like Ralph. Keep track of your crap. Alright? It's really not that hard. Keep all your receipts together. Keep the compensatory log. Okay? I think I might be saying that name wrong. Keep that log book, okay, of everything that happened throughout the year as it relates to your business. It's not hard. Anybody that's kept a food journal or anybody that's kept any kind of a daily journal, this doesn't even have to be daily. This just needs to be whenever you go out and do business related stuff. What you're doing is you're saving your ass. You're saving your own ass, okay? But you're not just saving your ass from an audit. You're also, as you're writing that stuff in that journal, you are adjusting your gross income. You're going to be paying less on taxes at the end of the year, okay? Very important. Look at Ralph, $3,500 down to $500, just from adjusting his gross income, from keeping track in his compensatory log. Anyways, I hope this video has been helpful to you guys. It's been way too long, but it's over now. If you get a chance, be like Ralph. Go check out adventuresontheriver.com. It can help you make money. I'll catch up with you guys next time. If you like this video, please subscribe to my channel. Please like, please share. I can use all the subscribers I could get. Catch up with you guys next time. Peace.